All right, good morning, everybody. Today is day 2 of our 4-day workshop. I hope everybody got at least a few hours sleep last night because we have another real full day of great trading ideas. Yuri Shramenko will be challenging everybody on their belief on market and price action today. It's going to be a very interesting talk this morning. Our lunch is scheduled for 12 o'clock, even though the handout said 11:30 this morning. They're going to be ready for us at noon today. Later, Mark is going to be demonstrating some new price and time tools and techniques that anyone could use to enhance their trading. Tomorrow, I want to remind you that we're starting very early. We'll be starting with the Euro at 6:30. If you plan to come with your computer, we ask that you get here by 6 o'clock. It's a distraction if Yuri's up here trading and trying to explain what's going on and someone's coming plugging their computers and stuff. So be here by at least 6 o'clock tomorrow morning. Okay, Yuri's going to be kicking off this morning. Yuri began trading futures back in 1986 and became a full-time trader in 1989. He trades the S&P and bond futures as well as swing trades soybeans, live cattle, and gold. Most recently, he's added the Euro futures as one of his key contracts. In 1990, he began experimenting with time analysis, and by 1991 shifted to time analysis as his primary analysis tool using market geometry techniques. In 1997, he began studying market noise and nonlinear data, which led to some enhanced timing techniques. In early 2004, he formed Technical Edge, whose stated purpose is to train traders through special courses and personal training. Yuri has a master's in psychology from Rutgers University Institute of Cognitive Studies and authored a book titled Create Your Trading Plan. Yuri's talk this morning addresses why price volatility causes any form of analysis to give false trading signals. So let's all please welcome Yuri Shramenko.
Thank you, great to be here.
Here. You stick that in.
Thanks. Okay. Well, I've got 3 parts to my presentation this morning. The first part's just about 10 minutes. It's an introduction to my trading methodology. And I'm going to ask you guys a few questions. Then I'm going to talk about overnight swing trading. Then I'm going to talk about day trading. In the swing trading, I'm going to give you a few ideas that you can take and run with to incorporate into your own trading styles, your own swing trading styles. For day trading, though, I'm going to give you very specific techniques, the stuff that I'll actually be trading Monday and Tuesday. Now, Ron already told you my introduction, so I'm going to get right to talking about myself. Ron mentioned that I spent a number of months, actually a few years, studying nonlinear data streams and how to retrofit my trading strategies to account for the fact that markets have so much apparent randomness in them, apparent noise in them, and a mathematician or a statistician would call it a nonlinear data stream. And just to give you an idea of what I'm about and then to ask you guys a few questions, I'm going to actually exit out of this for a moment. And a lot of people have seen this already. This is almost like a little toy. It's almost humorous. But what this is, this little spreadsheet makes a good vehicle when I only have about 5 minutes to talk about my understanding of markets. And when I give you my trading techniques today, both for swing trading and for day trading, they're actually, I didn't really go out there. Hey, I just want to find out what works, and I want to use that. I don't really need to know market theory. My modus operandi, after only about 4 or 5 years of trading by 1991, was I got to start at the very bottom. I have to develop an understanding of the market that I really do understand, and based on my understanding of the market, I can build trading strategies. And then I can go from strategy to tactic, which is the actual trading techniques, that I use. And why is that important? That's important because, 1 minute segue into trading psychology. Ultimately, you're going to trade your belief system. Even if you're using a mechanical trading system, those elements which you choose to incorporate into your trading system are going to be channeled or funneled through the vision you have of the markets through your own personal belief system. Furthermore, most mechanical traders will tell you that they sometimes don't take their trading signals. When the system's hot, they overtrade it. When the system seems to be cold, they stop trading it. Then, of course, when it gets hot again, they're not trading. A discretionary trader always has this issue of knowing which tools to use, which tools to emphasize, and how to integrate them into a decision-making process. So actually, the underlying tone that I get when I give seminars, especially in Southern California, is, you know what, skip the theory part, get right to the techniques. I just want to know what works. I'm going to show you why that may not be a good idea, and this spreadsheet actually helps illustrate that. This column of numbers over here, I'm going to show you what that is. It's a random number between -10 and 10. And what I'm doing is I'm adding this number to this number. So this is a random -9. It gets added to 1. There's your -8. Here's another -9. It gets added to -8, and that becomes a -17. And I do this for about 1,000 iterations, and I chart it. That's what this is. I'm charting a random number series. Then over here, L1, L2, and L3, that's simply give me a random number between -100 and +100. Same thing over here, random number between, and I chart those 3 lines. So what's this about? What kind of toy is this? Actually, I call this Yuri's secret vibration numbers because you can see how accurately I picked the top. You can see that I'm picking a support resistance level here. And every time I hit F9 here, it'll refresh everything, all the numbers and all. So once again, I'm finding a support level.
What is generating that? L1, L2, L3?
What's generating it? Microsoft Excel has got an instruction in it to generate a random number.
I mean, those are the L1, L2, L3.
Yeah. So we can actually, yeah, well, the first column is a random number, which is this stuff, the first column, all right? And columns 3, 4, and 5 are these horizontal lines. There's a couple of things I can point out here, and we can start with that we can see that we have trends in here. We have chart patterns in here. We have a slanted head and shoulders with a neckline, rather steep neckline. We have, you know, if you look long enough, you can actually see a lot of different things. We have support resistance levels. And when you hit these, sometimes you get really nice, interesting formations, you know, like this. You know, there's the touch, there's the support, there's the touch. And it almost seems like, no, I've got secret code in there. And the point of all this is that most people, unfortunately, through the trading vendors that are out there, are being led to believe that there's some sort of a perfect order to the market that's maybe not knowable intellectually, but maybe it can be captured by a neural net, or maybe it can be captured by their black box system, or maybe it can be captured by their newsletter or something. And the point I'm trying to make is that, you know, this interesting stuff is that a random number series really starts looking like the price charts we look at. Now, this doesn't prove anything in terms of a price chart, just the fact that it looks like it, but let's decompose it just for about 2 minutes. And what we'll look at is the fact that if I were to say, hey, you know what, I'm going to generate a column of random numbers between -10 and 10, you would think, most everybody, if I were to ask the question, and I do this in Southern California where I have more time, where I do market theory talks, they would expect a line that kind of vacillates. You know, you would have 0, let's say that was 0, you would have something that vacillates around here. This is almost unthinkable that you would have these sorts of trends. And here's something that every mathematician or statistician knows, that a random number series creates clusters. And in nature, nothing emulates the type of randomness we think of when we have randomness. If I were to do a coin flip, you guys would think that, oh, if I were to just do 10, I would probably on average have 5 heads and 5 tails. It never works like that. Usually you get 3 heads, 7 tails, 3 heads, 8 heads, 2 tails. You have to start approaching maybe 60 or 70 coin flips before you start approaching 50%. And you'll find that you'll have a variance between 45 and 55% heads and tails. Not just that, if you were to examine that coin flip, you would see streaks of heads and streaks of tails. Because in nature, that's the way it works. I can go on with that a long time, but I have to stop this because basically, I did go on a long time in Orlando on market theory, and they asked me to focus more on techniques this time. So what I'm going to suggest, if you're interested in this topic, I have a free download on my website. It's the first few chapters of my trade plan book. Just go to my website, the articles and techniques section. In the middle of that page, you can download the first 3 chapters of my trade plan book. But what we're kind of seeing here is that it's possible, if you were to make the leap of faith that a price chart contains a lot of randomness, if you're just looking at one time frame and you're just looking at one way of generating support resistance lines, or you're just using one statistical indicator like stochastics or RSI or MACD or any of the momentum oscillators or moving averages, if you're just using a couple of statistical indicators on one price chart, the odds are that over time you're going to have a lot more losses than wins, because too many of the trading systems will be generated by a random series of events. Even though I have nice trends here, because this is a random number series, I never really know what's going to happen next. All I know is occasionally I have little ranges, or I have trends, I have support resistance levels, but it's all random and trying to predict what happens next. So the next thing for me to do is to say, okay, try to tell me why that has anything to do with the price series. And here's how we do that. And the reason I believe there's so much market noise and random price behavior in a price series is because a nonlinear data stream, now why am I calling a price series a nonlinear data stream? Because at any point in time, the prices that you see coming across that populate the price bars on your charts, well, you know what it is? We think that the market is an entity that is giving us prices. We think of it as one thing which is generating prices. But actually, that's not the fact. Actually, there's a number of different players in the market. There's institutional traders, commercial traders, there's market makers, there's hedgers, there's large institutional traders like money managers or wealthy people trading size. There's professional traders, there's retail traders, there are novice self-directed retail traders. There's probably 8 different categories of traders, and you never know when a price comes across whether it's a knowledgeable professional, whether it's a novice retail trader. You also don't know if the price coming across to populate, the next bar is coming from a person who's opening a position or a person who's closing a position, a person whose stop loss is getting hit. He really doesn't have an opinion on the direction of the market now. His opinion was the market would go up. His stop just got hit going down. Because of the fact that we don't know who the originator is of a price move, we don't know what their intent was. We don't know if they're a hedger. We don't know if they're opening or closing a position. We don't know if they're using a strategy that says if I lose 5% or I gain 5%, I'm just going to lift my position regardless, mechanically, regardless of whether the trend is still intact. Because of that, the traditional way we have of thinking about the markets, that the market is a balance of supply and demand, that the market represents a battle between bulls and bears. When you decompose it down to the granular level, it falls apart. We don't really know when a price is coming across who the originator is. We don't know what their motive is. We don't know if it's opening or closing a position. And because of that, mathematicians call market data, price data, they call it a nonlinear data stream, and there's numerous business schools and mathematical papers written on the close relationship between market data and random price series. So I don't want to beat this to death. I don't think there's any reason I really need to read this at you. It's in the slide. But what I wanted to share with you is that when I started developing systems, I was a trader probably for 4 years, pretty much make money, lose money, make money, lose money, make money, lose money. And then after about 4 years, I said, this is ridiculous. I wanted to go full-time trading. But to get that confidence level, I realized that my feeling of just going out there and looking what other traders were doing, trying to get what works, really wasn't going to work for me. One, my confidence wasn't strong, and two, well, I don't want to go back to the Excel spreadsheet, but by that time I had begun noticing that market data is like a random price series, and random price series have clusters. So if I were to just look at what worked recently, if someone were to show me 1 or 2 years of a daily chart and show me this combination of indicators is picking 80% winners, I would have this doubt, and that doubt would be that maybe that's because that's the current cluster in the market. Just like when we looked at that random price series, we would see big trends going on for maybe 200 data points up or down, and then we would maybe see 75 data points where the market's going sideways. So, if you're developing your system during that trend period, you would develop one type of system that would catch trends, but you never know when the volatility pattern in that market is going to change. And because of that, I became very suspicious of that approach, just show me what works. I became very suspicious of, when the system writer, the meta stock, and the others developed optimizers of optimizing systems on the past year or two of data. I didn't have confidence to trade that, and I realized I need to go a little deeper and develop an understanding of the markets, a philosophy of market theory, and build my trading methods based on that. So basically, every technique that we're going to look at today, we're going to be able to trace back to this underlying suspicion I have of price data and a random number series being too closely related. So we're going to look at, for overnight swing trading, 2 different methods. The first one we're going to look at is range bars, which reduces market noise. It doesn't really eliminate it, but it reduces it quite a bit. Here's the analogy I give. I give a little baseball story. Let's say we've got 2 major leaguers, and maybe it's their first or second year in their majors. A batter who hits 200, his batting average is 200, is going to only be around for about a year if he doesn't get better by the end of the year. He's going to sink back down to the minor leagues, and it may be a long time before they call him up again. A batter, his first or second year, who averages 300, is going to get a multi-million-dollar salary, guaranteed contract for a number of years. He's going to have a fan club. He's going to be interviewed in magazines. He's going to be interviewed on talk shows. And if he does it for a number of years consecutive, he's going to the Hall of Fame. And it's the difference between 2 hits every 10 times at bat and 3 hits every 10 times at bat. It doesn't sound like a big difference. That's all it is. It's like 1 hit every 10 times at bat difference. So in trading, the difference of upping your trading edge just a little can have significant results. If you're like 50% break even on your trades with a 1.5 to 1 average profit to average loss ratio, you're really not going to do very well because of slippage, commissions, and the occasional missed trade, the occasional botched trade. If you can up that to 55% wins with a 2 to 1 loss factor, now you can survive if you're trading size. But if you've got a small account, you still won't be able to survive. If you can get it up to 60% winning trades with a 2.2 to 2.5 average profit to average loss, now you can get out of the rat race, trade at home, and be a self-sufficient trader. That's really all it takes. So when you look at this, just like every trader who's come up here has told you, hey, I don't have the holy grail, all that. It's true, because all you really need is that sort of an edge to become a self-directed trader. Decent money management skills with an edge above the average trader's results is all you need. And the things we're going to look at today, both for swing trading and day trading, will get you there. So first we'll take a look. And that little spiel you heard me say was this. Now before I get to this, like I said, I want to ask you guys a couple of questions. How many people here are either actively or want to be overnight traders, swing traders? Okay, that's really good information for me to know. Now, how many of you are either actively or want to be active day traders? Okay, so that's the majority, but it's about a 75 to 25% ratio. And a few of you raised your hand twice. So let me just say that. How many people would like to be full-time traders who both day trade and swing trade? That's really interesting. Wow. That's actually very surprising, because when I've done this before, there's usually only a couple people who want to do both. But that's what I did for many years. Just to let you know, because I'm running Tech Edge right now, I'm primarily day trading, and I've had to put the swing trading on hold just because Tech Edge, my little business where I train traders and I give talks and write articles and stuff, it's gotten pretty busy. But for over a decade, that's what I did. I did both swing trading and day trading, and the type of analysis you do is different. And the reason I mention that is because when we take a look at the way I swing trade and then you look at how I day trade, they're very, very different. And the reason they're different is exactly because of the market noise element. The shorter time frame you use, the more market noise is present. The larger time frame you use, the less market noise, but also the later your entries will be. An example of that would be candlesticks. Candlesticks on daily charts are okay. Combined with other things, they're useful. But on weekly charts, candle patterns are much more effective. So why don't we all just use weekly charts? Well, it's because your entry would be quite late. By the time the candle formation finishes on a weekly chart, the move you're interested in getting has already begun, and it may be halfway to the profit objective already. So using a weekly chart for swing trading isn't efficient. You eliminated market noise, but you're going to have late entries. So you use a daily chart, and it's just okay. If you use 30-minute charts and candlestick patterns and the same momentum oscillators that you used on weekly charts, well, yeah, on your winning trades, you're going to get in much earlier, and you're going to capture more profit. But you know what? You're going to have more losing trades, because the shorter the time frame, the more market noise, and the more likely it is that you will have that random noise falsely imitating or mimicking the trade setups that you've agreed with yourself to trade. Before I do this, just one more quick series of questions. Of the people who day trade, how many of you either want to or are trading the EURFX, the EUR-USD? That's actually a pretty good amount. Now, how many people are trading stock index futures, minis or whatever? A little bit more, that's pretty normal too. How many people are trading a bond like the ZN contract? Wow, that's pretty cool. Has anybody here started trading the crude oil mini? This is a pretty good group. Usually I get zero response for that one. So that's interesting. On Tuesday, I'll be able to trade whatever I want. I'm going to start tomorrow with the EURFX, but on Tuesday, I'll be able to trade whatever market appears to be hot, has the most trend in it. So that's what we'll do. We should have a lot of fun on Tuesday doing that. Here's the characteristics of why we use range bars, and I'll show you how these are constructed and what they really mean, because I know a number of people, even though it's been in FibTrader for a while, are unfamiliar with this idea of range bars. Why we use them is to reduce market noise. What it allows me to do in my trading is find the dominant cycle, if any, inside those range bars. And then the idea is if I can find the dominant cycle, I can go to step 3, which is I can trade momentum at dynamic support resistance within that cycle. Now, we don't really know how I do that. We're going to look at that in the next few slides. And I use swing lines for trade management. When you see me use this word swing line, what I'm referring to is inside Fibonacci Trader, there's a number of indicators that I generically call swing lines, and those would be your dynamic trio, your triple switch, fast point, high-low activator, flip it. They all basically, I call them swing lines, and as we're examining the chart, I think it'll get a little clearer why I do that. First, I want to get your interest whetted, if you're not already into range bars, why they might be something you want to consider to add, especially to your overnight swing trading. You can certainly do your system tests that Perry was showing you yesterday using range bars instead of intraday or daily charts. Or you can go real hog wild and have similar systems running on daily charts and also running on range bar charts, and seeing where you get a confluence of opinion, of agreement. That's actually pretty common. I've known a lot of professional traders who trade by having about 4 or 5 different trading systems, and they run them every night, and they only trade when 3 of them are agreeing within a day or two of a swing about to begin or end. On the left, I've got an S&P 30-minute chart, and it's covering about 6 weeks. I have the exact same 6 weeks on a range bar chart. I think this one here is a 4-point range. I actually use 5 points for trading. This is a 4-point one. And you can actually see that even though they're covering the same amount of time, you can see how much more market noise there is in here that can trigger in a swing trading system a buy or a sell. That wouldn't happen here. The swings here are what I would call technically pure. By technically pure, I'm referring to less volatility, less choppiness. I mean, basically, if you had your choice in hindsight, which market would you rather trade? Most of us would say the one on the right. And on here, I'm displaying The balance step next is the black line. That's also another swing line. And you can actually see how well it fits. If you were to do the same thing here with any of the swing lines, you'd have quite a bit of flipping action here. Here, you know, it captures the entire downtrend, then it captures pretty much the entire uptrend to the top. This is the range bar that I use. It's a 0.005 for the Euro USD or the 6C. You know, you can trade the Euro USD through a forex dealer, or you can trade it through the Chicago Mercantile Exchange, the symbol being 6C. Did you have a question? 0.0005 for overnight swing trading. And yeah, 50 tick bar. Because this is the 6C, it's ticks, not pips. They're the same thing. But what I'm trying to show with this slide, we're going to get into how how it's used and how do you select the range per market as time passes. For one thing, you guys may want to trade stocks, you may want to trade other futures. So just knowing the value I use for the Euro USD really isn't that valuable. The issue is, hey, how did you select that value? So we're going to take a look at that over the next few slides. One thing we can catch, here I'm using the stochastic RSI indicator. One thing is when you reduce market noise with a range bar, let's say you get a range bar value that seems reasonable, and we'll look at that in a couple of slides, how you do that. But once you get that, you should be able to apply a fast oscillator, and you should be able to see that you don't have lag. That when this thing turns, price turns also. And so we've got a nearly 100% correlation, no more than a 1 bar lag. And that's what I'm looking for. So what you want to use is a fast oscillator. What's a slow oscillator would be something like your regular MACD. Or I'm using a price oscillator where I'm subtracting 2 moving averages. If I'm subtracting a 20-period moving average from a 50-period moving average, that's a slow oscillator. If I'm using Tom Joseph, subtract the 5-period moving average from a 35-period moving average, that's really between the two. That's between fast and slow, but it's more on the slow side. That's a slow oscillator. Probably the fastest oscillator we have out there would be Williams %R. That's just a hyperphrenic type of an oscillator. The stochastic RSI is just right. It's really a stochastic based not on price, but based on an RSI of price. So first you do an RSI, and then you do a stochastic on that. And in a Fibonacci trader, that's one study. You don't have to first do RSI and then plot stochastic on it. It actually exists as one study, and that's a relatively fast oscillator. If you were to use that on a short time frame, like a 5 or a 10-minute chart, you would get whipsawed. You know, you wouldn't use it more than 1 or 2 days. If you use it on a daily chart, it's just okay. You use it on a range bar chart or any sort of chart form, which is noise reduced, and all of a sudden you start getting effects like this, where, you know, almost by itself, you can get it. You know, of course, this would just be for entry. This doesn't have any trade management stuff in it, but you get almost a complete entry system just by doing something this simple. So how does one go about figuring out, hey, this is the range I want to use per market? Well, what I do is for swing trading, I'll plot a daily chart. When I get to the day trading part, I have it's a different, similar but different methodology. But for swing trading, I start with a daily chart, and I run a Fibonacci trader study called the True Range Average. And I do it on a fairly short time period. I believe I use 8. I think the default value might be a little higher. But what I do after I plot it, I want to make sure I've got at least a half year of data here. What I do is I look for areas where there is support and resistance, where price, when it's coming down, will bounce off it, and when price is coming up, will bounce off it, okay? So that's usually about the middle. But then I move my line, you know, I do a horizontal line, and I move it so that I can see that several times it's acted as support resistance. Then maybe I'll go back another 6 months, I'll scroll backwards in time, and then I get a nice comfort level for the value, which is sometimes support and sometimes resistance. And for the 6E contract, that's right at 0.005. Then the next thing I'll do is I'll plot the dynamic trio swing line. And what I want to do is I want to see at least a couple of instances where it acts, see these red circles? it's acting as support or resistance. If I get that several times, if I do that true range average test, and then I do this test with the swing line and see that it's acting as support resistance, then I know that I found the right range bar value, and I'll be able to use it inside a trade plan, trade setups. So this is just another market. This is the Dow. The last one was the 6C. This is the Dow Jones Industrial Average. It's the same thing. You can see I'm using the daily chart. You can see the support resistance areas right here. And then when I apply the swing line, I know I've got the right value. And that value is actually pretty high. This is the prior slide. That value is right at 90 ticks. Yeah, that's 90 points. That's pretty high, but that's what it came out to. But then when you look at it, I've got, let's see, from April, early April to late June. And you can actually see, though, that the swing line here is actually working pretty well. And there's a no lag feature with the Stochh RSI again. So, you can actually see there's potential here for using this inside trade setups. And there's one other thing you can do once you get a range bar value that you've tested out and it looks appropriate. You can take the Stochh RSI, and if you right-click that thing, you'll see if you get a pop-up window, you scroll down, you get divergences. You enable divergences, and what you'll find is, Fibonacci Trader draws these arrows for you automatically when it spots both regular and hidden divergence. If you do this on a price series which has too much random noise, you'll get good signals, but you'll also get too many bad signals. When you do it on a noise-reduced chart form like a range bar, you'll find that the number of bad signals are reduced fairly dramatically, and you get some really, very nice calls. Some of this is very sweet, and you can actually start seeing right now, wow, if I use these divergence arrows and I wait for price to penetrate the swing line and my momentum oscillator is falling, now I've got several things which are uncorrelated on a reduced chart form, which is going to, you have a good confidence feeling that you'll get fewer false trading signals. Now you're starting to get to a point where you can develop an overnight swing trading system that is based on fairly sound market theory, and you can actually see how this methodology is developed. In other words, your belief system shouldn't have too much trouble accepting this. So when you get test results that are favorable, you should have the more confidence to trade them, which is really in the life of a trader. Like Perry said yesterday, I can't talk about too much trader psychology here, but most of the game is played between your ears. So just showing you things that work is really a big fake out, because if you were mature traders, your first thought that you should have is, how do I know that's just not over-optimized stuff that's working on the current clustering effect in the market that won't be working 2 months from now? When you deal with a methodology like this, you should be able to bring up charts from the 1980s, the 1990s, the early 2000s, and you should be able to get good results. When we get into market geometry in a few minutes, I usually, when traders come over to visit me, I give them a demo of market geometry, and one of the things I do is I bring up S&P, soybeans, live cattle from the 1960s, and we apply the techniques to a few charts in the 60s, a few charts in the 70s, a few charts in the 80s, and the volatility patterns were very different in those time periods, and they can actually see that, hey, this thing, it's not perfect, but boy, without having to always wondering, should I go out and get another trading system? Do I need to continue my education? Should I start reading more books? Should I develop another trading system? I can actually use this, and year after year, decade after decade, it gives good results. That's a big thing. So one thing I want to show you too, this comes with Fibonacci Trader. I think it's a pretty nice thing. This is using the electronic T-notes, the ZN. The symbol is ZN. And what I'll be doing is I'm using a range bar here developed the same way that you saw me do EuroFX and the Dow Jones. And I'm using, first of all, I'm defining this as 60/4, and I'm using a 0.16 range bar value. And what I'll be doing is I'm applying the Gann Basic Swing Plan 1. The only modifications I made to it is I changed it uses the high-low activator. I changed the look back from 3 to 5. And inside the GAN swing indicator, I enabled fast track to Y. Okay, those are the only changes I make. And here's what's going on. It's actually pretty nice. You can see over here, I'm looking at this date range here, early May to just past the middle of June, and we've got a pretty decent, win to loss ratio there. Now over here, what I'm doing is I'm doing the exact same thing on a 30-minute bar chart of the ZN, and you can actually see that it's a loser. Our gross profit was 1.77 points, and our gross loss is 5.2. Comparing that to the exact same date range, using range bars, we have a winner. Comparing it to the exact same date range using a 30-minute chart, we have a loser. Also, I think, if you don't mind, I did this for the Orlando seminar. What I did on Friday before I flew out here was I ran this thing again. And let me I'm not used to this, so just give me a moment here. There it goes. In someplace in here. I had this open before, but it got closed. I'm trying to find where Carlos has my folder.
Go to recent documents.
Yeah, would that be like hanging off out here? Documents, recent? Yeah, this should do it. So let me go back, forward in time. Yeah. So here it is. You can see it's from July 12th to September 9th, a nearly 2-month period, and we've still got that pretty decent, for this is totally mechanical brain dead type trading. 5.64 is your gross profit, 2.43 is your gross loss. You have the same number of winning trades and losing trades, but an appealing factor is the average win, average loss. You can see it's actually largest winning trade, largest losing trade, average winning trade. So this is pretty decent. If you can have a swing trading system that's 100% mechanical, no thought involved at all, and it seems month after month it's generating you a decent profit, that's hot. But you have to also remember, hey, is this thing going to work? Well, yeah, it probably will continue to work like this because it's the chart form you're basing it on. You've built it up from ground level with sound market theory. And let me get out of here and go back to my presentation. Nope, that's not what I wanted. Let me just. So what we're going to do now is I finished. Actually, I should ask, does anybody have any questions on range bars or the type of things that I just did? Because we're going to move on to market geometry now. Okay, so that's one way I have of dealing with random market noise. I reduce the market noise by the chart form. Another way is to use, and again, you don't have to agree with this. I'm going to tell you my belief system, okay? This is like sharing. It's not something you have to believe verbatim. In Southern California, that's a very big thing. I'm sharing my feelings, But what we've got here is, in my belief system, price stops being an NLDS at significant pivot points. And you may not know it till price is here, for example, that this was a significant pivot point. But for market geometry, that's totally acceptable because what you're going to be doing in most market geometry techniques is going into the past to project something that may happen in the future. So it's okay that you're waiting until here or here to identify that as a significant pivot. The reason I say that this may be outside the random noise effects of a nonlinear data stream is because at this point I have an area where all the market participants agreed, because if anybody at all wanted to place an order to buy here, price would have gone up another tick. Whether you're a retail trader or a hedger or a professional or a market maker, this is where the rally stopped, and there's no question about it. By the time price gets here, we know that there was universal agreement among all the people who trade that market that that was it for that rally. So because of that, again, you got to remember, why do we think this is an NLDS? It's because we can't identify the trader. We don't know if it's a knowledgeable professional. We don't know if it's a hedger. We don't know if it's a market maker cleaning out his books. We don't know if it's a rather ignorant new novice self-directed at-home trader. We just don't know, and we don't know what their motive is in trading. Are they day trading, swing trading? Are they position trading? Are they closing a position, opening a position? We just don't know. That's why we call this a nonlinear data stream. But at these points we do know. And that gives us the confidence to start using these points in market geometry. What's interesting about market geometry is, let's say you were to use these 2 points here in some kind of study, you ignore 99.9% of all the data. You totally ignore all the data in here. If you were to draw a Fibonacci retracement, think about it, you're really totally ignoring all the information inside these charts. Which brings me to like a key concept in market geometry, that not all price points are treated equally. They're not all weighted the same. Some are very significant, these guys, and some are totally insignificant, these guys. But when you do something which I think, pardon my bluntness, when you do something which I consider statistically and mathematically silly, run regular statistics like a moving average or a momentum oscillator on a regular price series, you're actually applying statistics to something a mathematician or a statistician would tell you, hey, that doesn't make any sense to run a regular statistical study on a nonlinear data stream, all right? And when you do that, when you run your moving average or when you run your RSI on a price data series, that study, the RSI or the moving average, it considers that this price point and that price point have totally equal value. Every price point has the exact same weight in a statistical study. In market geometry, it's the exact opposite. This stuff is totally ignored, and we're focusing primarily on these significant points where all the market participants had a temporary agreement. These are red because these guys are what we call significant. The green ones really aren't as significant. You can use them, but the results won't be as sound. They're definitely pivots. Well, let's start looking at a few examples, and probably, for most market geometry students, you're not going to get 100% agreement on this, but the base tool would be the Andrews pitchfork. And all charting packages have them, and Fibonacci Trader actually has a pretty sophisticated pitchfork. You can have inner lines, you can have outer lines, just the way Dr. Alan Andrews, who invented this around 1950, used it. We call this market geometry because this point here, the way we draw an Andrews pitchfork is you have to find 3 pivots. And from pivot B to pivot C, you count the number of price bars and find the middle. So you're finding the middle, the 50% point in time. Then you're finding the 50% retracement in price between B and C. So this dot right there, that's the 50% retracement in time and in price. So from this pivot, we draw a line through there. Then we create a parallel trend line, and you would drag it right there. You create another parallel trend line, and you would drag it there. Now, of course, when you draw the pitchfork, you don't have to do that. I'm just telling you how it was constructed in the old days, going back 15 years before charting software did it for us. But that's why this gets called market geometry. There's that a structure of 50% to it, and regardless of when you draw an Andrews pitchfork, you'll find that it acts as support and resistance. By itself, it's not a particularly useful trading tool. As a matter of fact, it would probably hurt you more than help you. But symbol observation, you can draw 100 of these in less than an hour on different charts and on different time frames, and see that over and over, it seems to be catching the tops of swings and the bottoms of swings in markets. The problem is you don't know if you're going to get a 1-bar pivot there, or you're going to congest there, or you're going to go a little bit above it or a little bit below it. Well, we'll look at more examples in a moment, but before we do that, I wanted to point something out that as we're looking at these examples, may be helpful in our understanding. And that's that one of the reasons market geometry has survived the decades of use, because W.D. Gann used, he didn't do a whole lot of statistical studies, and neither did Edwards and McGee. They used chart patterns. Gann used market geometry and other ways of identifying cycles. Dr. Alan Andrews, by the late 1940s, and Charles Babson, these are people who are self-made millionaires. Before they spoke to the public, they had traded their way into millions of dollars worth of profits. And their primary trading techniques is market geometry. Now here's the good news. The mechanical trading systems we can develop with indicators have to be reviewed, modified, and re-optimized every now and then. Market geometry doesn't have to be because it's self-optimizing. And let's take a look at how that is facilitated. Because I have 3 points, if this were a little lower, my 50% would be lower. If this had a few more price bars here, my 50% time division would be different. If A is higher or lower, this line here would be at a different angle. So whether you have more time or less time, whether you have more or less range between B and C, and whether A is higher or lower, you're going to get a different drawn pitchfork. This is not optimized on the most current price data, the most current number, last few pitchforks we had. This thing is always absolutely current with the rhythm and the volatility patterns present in the market. And that's why a tool like this, decade after decade, I have soybeans going back to 1948. I've done soybeans in the 50s. I have the Dow Jones Industrial Average daily price chart going back to 1925. I can draw pitchforks on 1928, 29. I can draw them during the Great Depression. They just always work. But again, you can't trade them by themselves, but we'll look at how you can integrate them into a trading plan in just a few minutes. Nope, wrong way. So the way Dr. Alan Andrews used a pitchfork is if you had a nice wide range here, he would also draw the 50% between here and here. And he would also draw one out here. And we can actually see that when you do that, now you're really starting to kick. Because now it seems like you almost have something that lets you identify dynamic support resistance. When you say regular support resistance, usually what you're referring to is when if you have a significant pivot, you would draw a horizontal line that way, and that's traditional support resistance. Or you can come up with something like, we have some pretty sophisticated swing lines in Fibonacci Trader. You can say the dynamic trio swing line offers us dynamic support resistance. But that's what this is. Because it's not projected directly from, it's not derived directly from one price point, but this kind of like a formula, we call these things dynamic support resistance. And as you look at charts more and more over and over, you can actually see that we're calling the tops and bottoms. So this tool is pretty good, but I want to show you what used to be a secret enhancement to this that really wasn't that well known until just maybe the past 2 years. But it's been around. I can guarantee you this technique I'm going to show you has been around for decades. And it's called the 50% pitchfork. We can see this pitchfork isn't that bad, but we can improve it. Just like we found this point being the 50% retracement in price and time between these two pivots, we can do the exact same thing using these two pivots for the starting point of our median line. That's what this is called, the median line of the pitchfork. And the way we do that is the exact same process. We just find the 50% point. And when I do that, see, this horizontal line is the 50% retracement. And you just have to accept on faith that I counted the bars, and there's your 50% in time. There's the same number of price bars to the right and left between these two pivots. And when you do that, look at the difference in how this pitchfork looks. And you know what? You can actually have both up on the same chart, which is what I often do. Because if you do have this one up and this one up at the same time, what you'll find is that it's actually catching, both of them are catching some of these pivots simultaneously. And when they do that, and you get a pivot at a place where two pitchfork lines are present at the same time, now you're talking. Now you know you're going to get some follow through. Now you know that if your mechanical or your discretionary swing trading system says to be, let's say, a buyer here, that could be a very, very good trade because you have two of these different swing lines. Well, actually, here not that good, but that's the concept. That when two of these swing lines, like over here, two of these pitchfork lines come together, and a price-based system is telling you a signal, you've just reduced the number of losing trades you're probably going to get from your swing trading system. So here is the EuroFX daily chart, and here There's maybe too many price bars here. This again is it's not a bad pitchfork, but I'm not really catching these lows. When I turn it into a 50% pitchfork, all of a sudden you get a completely different look. And here I'm adding the way Alan Andrews drew it. He didn't just draw the pitchfork, he always had the outer lines too. And if the range was wide, he had these inner lines. And on the 50% pitchfork, when you combine these two, you're actually catching almost every single swing, such that if your swing trading system gives you a sell signal, and simultaneously you're developing a pivot on one of these lines, well, now you've got two totally non-correlated things, and you've got some sound market theory supporting the decision of your price-based swing trading system.
I don't know how FT works. That point is not on any bar or anything, so you just find that point and then click on there or something. That's where it starts.
Well, yeah, actually, let me go through a few examples, then we'll draw one, okay, using Fibonacci Trader before we go to the next topic. And this would be one more reason you would want to, in a chart like this, sometimes you get price trends which are so steep, the pitchfork doesn't make sense because it's either going straight up or straight down. So this would be the Dow Jones Index, a regular pitchfork. And it may look good in hindsight. That's the only point that really looks good. When you do this on a 50% pitchfork, the exact same, all of a sudden, wow, you got the complete channel here. Then you got the next channel. So you actually have done some improvement there, and you've got some more information to use with the regular tools you're probably already using. Or, even better, combine this with the range bar system I showed you just before. See, that's not that bad an idea. So we're going to go into Fib price bands in a moment, but let's take a look at Fib Trader. Maybe we could take a look at, I should have an SP index chart loaded here. And just to show you how you would draw one of these, well, where is the little puppy? There it is. So if I were to draw, and where's my magnet? Yeah, it's enabled. So if I were to draw a regular pitchfork, I could have that effect right there. That's nice. But to turn this into a 50% pitchfork, this is all you really have to do. Let me just lift this out of here manually. I want to free up because I'll have to redraw this in a moment. Then all I do is I take the retracement study, use, and I'm interested only in the 50% line here. I'm going to delete this, but here, I'm sorry, I did that wrong. When I do these presentations, I'm not really a professional speaker. You'll see me making silly mistakes like that. So I want to draw my 50% retracement here. And there it is, this line right here. Then I just take a regular trend line. And there it is. And I'll draw it from here to here. So that intersection right there is the 50% point. So then I take this and I drag it right there. And then, of course, you can, just for clarity, let's just delete this stuff, erase all. And I don't need this anymore either. So when you look at this, this is the most, I guess, yeah, that's current. And if you look at it, the prior pitchfork wasn't that bad, but this one gives you a little bit more information. The outer lines did a pretty good job here. These bands, this median line, this is the new median line. It actually acted as a support for over a week. When it broke, you went to this. When this broke, you went to that. So by itself, again, you can't, even a 50% pitchfork, you can't trade by itself. But think of how nice it is if your swing trading system gave you a buy signal in here and you had this up, you would have extra confirmation. And if you only did trades where you had non-correlated methodologies agreeing with each other, I can guarantee you'll have better results.
Yuri, did you say that you can do this for some range bars?
Yeah, but it doesn't, logically, it doesn't make a whole lot of sense because, yeah, exactly, so you don't. What I said was you can draw your market geometry. We've only covered the first tool. We're going to cover a couple more tools. You can have your market geometry laid out, and then you have another range bar chart Okay, so what you want to do is you can approach it either way. When your range bar system is giving you a buy or a sell, you check your market geometry, or you check your market geometry studies and see that, hey, I have a pivot forming on dynamic support resistance, and I have maybe another market geometry tool that we'll cover soon saying, hey, this is time for a change. And at the same time, then you go check your range bar system and you notice, wow, 2 days later I just got a buy on my range bar system. Now you're kicking. So it would be like a structured approach where you're looking at different types of charts, in a sequence. Okay? Yeah?
How low of a time frame have you experienced valuable pitchforks?
Well, on stock indexes, you can go as low as 10 minutes. But generally, 30 minutes is as low as I'll go on any other commodity, whether it's bonds or the euro. On the euro, I like it on 240-minute charts. And of course on daily charts, always daily charts. And even though you can't get trades from it directly, for perspective, I always do my market geometry on a weekly chart also, just for perspective, just to know if I'm in a trade and I'm at a profit that I like. I want to know if I'm bumping up against, a support resistance from the weekly chart level. Yeah?
How critical is scaling, and how do you set your scaling in good
Well, for purposes of what we're doing, drawing these market geometry studies, the scaling won't hurt or help you. As new price bars get added, new highs and lows are made, this software will rescale the y-axis, and you'll find that your drawing tools automatically rescale perfectly. There's only one study, the FibArc, that doesn't, but every one of the drawing tools that I use rescales perfectly. Yeah?
Are you using a 240-minute on the euro because you use 24-hour data?
Yeah. That's just for market geometry. For trading it, I still use a range bar. For actual trades, get in, get out, manage the trade, I use a range bar. For market geometry by itself, it's actually a very esoteric, very, pretty powerful concept. Where people get thrown is that you don't trade it directly. It's a support structure, and people say, well, why do I need the support structure if I've got this trading system here? It's because this trading system here has losses, that's why. And you want to eliminate as many of those losses as possible, and you want to capitalize as much as possible on the winning trades. You want to be able to get as much profit as possible out of them, and you want to minimize the losses. So what you realize as a pro trader, this actually isn't, I'm being very blunt. I grew up in New York City, so this is my bluntness coming out. But I gotta be honest with you, having reviewed down through the years the types of literature and advertisements we get from most vendors, the charts they show their wonderful systems on? You can slap a 20-period moving average on them and do just as good as the system they're selling, because they're showing you charts that have these big swings in them. And if you slap a 20-period moving average and just trade the price penetrating the 20-period moving average, you'll do great. So the issue really isn't the entry system. The issue is knowing how to manage a trade and knowing when a trade has a greater probability of taking off. Why don't we all just trade a 20-period moving average? Because we know that we're going to get whipsawed too often when the market goes into a range. And the losses will offset the occasional big winner. So the name of this game is really learning how to manage your trades and learning how to maximize entries. Hey, get up the odds that this signal here is really going to take off. And that's what market geometry does for me. It ups the odds that the signals I'm getting from my range bar system are really going to take off and really be profitable. And the range bar system by itself, by reducing market noise, lowers the number of false trading signals I'm going to get, and then I lower it even further by applying market geometry, dynamic support resistance, and market geometry timing. Yeah, you.
I just want to confirm that. Are you saying that if you have your range bar swing trader chart that's giving you a signal, you may not take it if you can't find a market geometry chart?
Well, these days, yes. Again, I'm telling you how I trade. Primarily, in this part of the presentation, I want to give you things that you can use and review and integrate into your own trade plan. And don't forget, anybody can email me and ask questions about this stuff. I realize that in today's world, it's a primarily technical indicator put on a price chart world. Not too many people are reducing market noise with the chart form, and not too many people are using pitchforks and the other things you're going to see in a couple of minutes. So feel free to email me, that's not a problem. But yeah, that is what I'm saying. Again, you know, when I was going back maybe 15 years, and I was still pretty much, you know, looking for a mentor, I never really found a good one. The traders, at least who were able to survive, all said the same thing. You heard Dennis and Perry, and I'm sure Mark's going to say the same thing. You know, managing your losses is such a big deal. And one of the ways of managing your losses is to not even enter a trade unless it's copacetic. You're never going to get too many perfect setups, but if you use non-correlated methodologies, see, a correlated methodology would be if my RSI and my stochastic are both giving me a buy signal, or my stochastics and my MACD or MACD histogram are giving me a sell or buy signal within 2-3 days. That's not that good because those indicators are very similar. The mathematics behind their calculation is so similar that we call them correlated. But if I'm getting a pivot on a pitchfork, and I'm getting an oscillator upturn, and maybe I'm getting a break of a swing line like dynamic trio or triple switch, all those things are totally non-correlated. They have nothing, the calculation of those indicators have nothing to do with each other. And if my concern is that a random price series, like a market price series, has random noise that can trigger false trading signals, if I get 2 or 3 things simultaneously issuing a signal within a couple of days of each other, I feel that I've reduced the possibility that that's a false trading signal. And now I got something that I can trade with larger size. Because getting back to your question, if I go back 15, 17 years when I was primarily in training mode, most of the pro traders said, you know what your problem is? You overtrade. And I've been hearing that down through the years. Pro traders telling novice traders, you trade too much. You don't have the patience to wait for things to line up till when they're perfect. I read a transcript of Linda Bradford Rashke speaking at a seminar. Someone emailed it to me, and they said, you're probably going to like this because it agrees with what you say. And she said, you know, I trade like this, but my goal is to trade like my friends over here, and my trading friends here, they average 3-day trades a week. Think about that, 3-day trades a week. You're a day trader and you trade 3, well, she said 3 or 4. Because they wait for everything to line up perfectly. And you know what? Because I've been doing this so many years, I know she's right. And you know what? I can't do it. I have methodologies that tell me this is when I go for intraday swings and this is when I scalp. Because I can't sit in front of this damn screen for 4 hours. I usually take a 90-minute break during the trading day. I can't sit in front of that thing for 4.5 hours and stare at it and not trade. So at least I've disciplined myself to the point, okay, this is the methodology I use when everything's not copacetic. I scalp, and when everything lines up really nice, this is when I trade more contracts. I use a trailing stop with the swing lines. If I get stopped out, I immediately place an order for trade re-entry in case that was just some market noise. In case that trend resumes, I'm going to get swept right back up in it. And those things happen. Actually, to be honest with you, 2003, not so much 2004, but most of 2005, you may get 8, 9, sometimes 10 trades a week like that. Everything in the stock indexes, everything lines up very nicely that I look at, and you know, you get that nice $300 per contract move in the Russell in 20 minutes. You know, so we know it's out there, we know how to do it, but the problem is, this, like Perry said, the stuff between our ears. The Bradford Rashke's talking about probably pass on over 90% of the initial setup that they see before they actually place a trade. So let's move on to the next topic, and that would be fib price bands. What we're going to do is I'm going to finish my market geometry portion, and then before we start the day trading part, we'll take a 10-minute break, 10 to 15 minutes. This is something similar to what you saw Perry drawing yesterday. I have a technique that's a slight modification. To the best of my knowledge, this is pretty hot for 2 reasons. One, Fibonacci Trader is the only software I'm aware of that allows you to do the 3-pivot time expansion. There's several software out there that let you do the 2-pivot, but this is the only one out there. So if you can find something like this, that's really good because you know that there's not too many other traders doing it. So let me just show you how it works. What I'm doing here, I can stand. You see these 2 red lines going down vertically. First, I'm applying the fib price expansion tool. I'm clicking on A, and I'm holding my mouse down, and I'm dragging to B over here. Then I'm clicking on C, and that draws this red line. Then I'm using the exact same tool, click on A, hold the mouse down, drag to B, release it, but then I click on B a second time, and that draws my price expansion from here. And what I found is when I get a cluster off of the first wave of a up or down move, that's normally where price is going to stop. That's where it's going to pivot. And you can see it over here with these gold futures. You know, I'm doing the exact same technique. There's point A, B, C. So I'm doing the first one, A to B to C, and that's showing me the fib price expansions from this pivot. Then I'm doing the fib price expansions from that pivot. And where you get the first two, now I always use these two, okay? Like I don't use 1.38, I don't use 1.5. I always use the 0.62 or the whole number. And where you get the bands, where you get two of them from each of the trees coming together, those people who use my day trading methods and get my day trading newsletters, they see I put this out a lot. This happens virtually every single day in the Russell and every single day in the EuroFX. The swings end on bands like these. It happened Friday. Just, I was trading before I flew out here. I was trading, and the exact high in the EuroFX was one of these bands. And almost every single day, I had a trader from Portland trade with me Tuesday and Wednesday. And we were doing bands on the Russell, and 2 days in a row we caught the morning downswing ended on these bands. Then there was a rally that took out the entire downswing by at least $200 a contract, and it ended on one of these bands. And it was very simple. You just find the first wave. This is actually, I think, one of the coolest things that I've done, even though it's very simple, because again, you're looking at this by itself. Again, like most market geometry, you can't trade it by itself. But when you combine it with the swing lines, all of a sudden you have an entry method. And if you combine it, let's say you have a pitchfork line there, and you have these bands here, and price is pivoting there, and it breaks the swing line, and you're using a range bar, because on these guys you can definitely do on range bars. You can use them on volume bars, range bars, tick charts. Then all of a sudden you've got a lot of non-correlated things coming together that have worked for years and years and years, and your confidence in trading, and your something you have to do if you really want to be a full-time trader is you have to at some point in time deal with the issue of position sizing. I mean, when I'm scalping, I may just, when I'm trading in public or with the trader, I'll just do one contract, no more than two. Or when I'm scalping, I'll do one contract, no more than two. But when I'm trading by myself at home and I have a pure trade, the thing that has maybe 3 or 4 different indicators, market geometry, timers, and a swing line break, then I do 4 to 6 to 8 contracts, depending on, am I going with the current day trade? Is the current trend of the day also agreeing with the trend of the past few days? The more agreement I get, the more size I'm going to trade. And if you want to trade for a living, that's something that it's outside of the scope of what we're going to cover in the seminar, but that is an issue you have to deal with eventually. So what I'm saying is, by using non-correlated methodologies rather than just 1 or 2 trading methods, you're able to get that confidence that lets you start experimenting with position sizing. So this is just showing that you can do it on any time frame. This is the stock market crash that started in 2000. That ended October 10th, 2002. That's the low right there in the NASDAQ. That's wave 1. That's the end of wave 1. And there's your price bands. And you can actually see that even though it didn't go to the tick, we've been honoring trading inside the channel. One thing I can share with you, the reason I'm so hot on Fibonacci price expansions, most software has the Fibonacci retracement. In reality, nothing in nature retraces on a Fibonacci ratio. That's a purely man-made speculation. But everything in nature appears to grow on Fibonacci ratios. That's why when I do market studies, you'll hardly ever see me draw a Fibonacci retracement, but I draw the expansion all the time. I always have a chart that's got a Fibonacci expansion on it. Just to give you, and I don't really have it here. I don't think it's necessary to draw, but I'm drawing the expansion from here to here. Let's say price is down around over here, okay? somebody could draw a Fibonacci retracement from this point to that point. A person like myself would draw a Fibonacci expansion from there to there to there to try to catch, that. So it's your mindset. But 9 out of 10 traders who are willing to use a drawing tool, it's more than 9 out of 10, will use the Fibonacci retracement. If you spend just 20 minutes going over a number of charts and applying the Fibonacci retracement to pivots, it's really not a very good tool. I don't care how many times over the years you've read, I got this 618 retracement, I got my 38. If you look at a good number series, it really doesn't catch a lot of bounces, it doesn't catch a lot of pivots. Russell 2000 intraday, these actually, I believe, are my range bar charts that I use intraday. And this happens every day where the bands act as dynamic support resistance levels, price targets. Where I use these the most is those times when I get lucky, let's say, and I'm in a trade. Let's say my average profit is 13, 14 ticks in a Russell trade when things line up. Well, sometimes what happens is the market just shoots in your direction really rapidly, and now you find yourself, you enter the trade and it's 5 minutes later and you're between $250 and $300 per contract in the profit. And you say to yourself, okay, normally what I would do is use a swing line, but this market shot up so high that if I were to use my swing line as a trailing stop, I may give back half of my profit. And if I just arbitrarily take my profit here, I may feel really stupid because I'm supposed to be a professional trader, and what if this market continues to go up? I don't want to say to myself, well, some profit's better than no profit. That doesn't work at the professional level. So what you want to do is you want to have some kind of methodology, those times when the market extends in your favor, to get out at something sensible. So the main purpose of these bands is price targets, places where when the market extends your way, you're at a good profit, and you don't feel like using a trailing stop. Get out in the bands, and what I do, let's say just for example, I had some reason to sell over here, and now I took my profit inside here. What I do, as soon as I take my profit, I place a sell and a stop below the most recent pivot, such that if the move resumes fairly quickly, I get swept up in the flow again. Okay, and maybe we'll see that tomorrow, but you'll actually see me doing that a lot in my day trading newsletter. The last 2 issues I've been talking about trade reentry, and this is one of the reasons you do trade reentry. You're just getting out at, because again, I don't want to here my swing line never got violated, but just use your imagination, and let's say price got up here, if I entered here, I would have given half of my, or even more than half of my profit back. And I don't want to do that. So this is just one of those tools that lets you manage your trade a little bit better. And it's also useful if you're not in a trade, if you get a pivot inside those bands and you have other things like your swing trading system giving you a sell, pivots formed on pitchforks. So here we have an example of using a pitchfork with these price bands, and this is a technique that's been around since the late 1970s. Actually, the person I learned this from never taught it. He just told me. I used to be a computer programmer for a few years, so that when PCs began use for trading, I had a pretty interesting skill because I was a trader and I knew how to program things on a PC, and not too many people did in the mid-1980s. So I developed just a temporary friendship with Tom Joseph, and this is a technique that he taught me, that he said he used in the 70s and early 80s. And he used the pitchfork with Fibonacci retracement and Fibonacci expansions, and where you would get these intersects and price coming to that area at the same time. That's a very potent swing trading a pivot place. It's a way of predicting. So if price is right there, you can use your range bar or price swing line, regardless whether it's a price bar or whether it's a range bar. You would have your swing lines, and if price trades a few ticks above that swing line, you have a confidence level that that's going to be a swing that extends for you. So this is an example now of using market geometry for trading. Prior to this, we were looking at individual tools. You can start combining these things to develop trading methods that are pretty good, and they have the advantage for you, again, of being self-optimizing. You don't have to worry about the volatility pattern changing in the market and the trading system that you developed, however you developed it, not working anymore for a given period of time or maybe never again. You could do the same. Well, you would use the retracement if the first point of the pitchfork is between B and C rather than above or below it, and you've got a fairly wide range. Then you can use the the fib retracement, and it's the same exact. There they are. It's the same exact rationale. Retracement line, pitchfork line, and price all coming together at about the same place. You get a pivot there, and then you need some kind of a price-based trading system to enter and manage the trade. This would be, I guess, another. Does this seems?
Using expansion.
Yeah. Okay. Yeah. There you go. Yeah. Well, I mean, you can see it. I don't want to beat it to death. And this would be, the Euro USD 240 minute. When I was swing trading the Euro, I didn't use a daily chart that much. I used the 240 minute probably the most. And this would be an example of what I was doing back then, based on, same exact trading methodology. Okay. Let's take a 10-minute break. Can I ask you guys a favor? We started like 10, 12 minutes. Slides will be on the EuroFX. In my personal trading, about 65% of the day trades I do are in stock index minis, and about 35% of the trades are in the EuroFX. I can give you, without any trouble at all, the difference between the two. When I trade stock index futures, I have a higher winning percentage, but a smaller average profit per trade. When I trade the EuroFX, I get whipsawed more often, and the reason I'm willing to put up with that is when that puppy takes off, you're able to capture, $300-400 profits in 20-25 minutes. So I'm willing to, here's 4 or 5 tick losses, a couple in a row, to grab that big one. Sometimes, I don't get the whipsaw, but the thing about the EuroFX is it's not one of those markets that you're going to have a very, very high day trading winning percentage on. What the goal is to get the average profit to average loss, really a nice wide differential. And in my stock indexes, it's different. I have a much higher winning percentage, but the average profit to average loss is smaller. We're going to take a look at this stuff. I don't think you need me to read it at you, and we're actually a little bit late here, and I want to cover a lot of stuff. So the first one, first of all, when you look at theoretically, what is Yuri trying to do with the methods he's trading and the methods he's going to be presenting? I want to reduce market noise by using range bars. This is very similar to my swing trading stuff, but you're going to see it's actually different too when we get into it. I'm going to find the dominant cycle inside those range bars, then trade momentum within that cycle using volume bars this time. The only market geometry tool I use in day trading is those fib expansions. I hardly do any other form of market geometry these days in day trading. Then I'm going to apply swing lines to the volume bars for trade management. And then if there's no cycle, so if I see how I have if any here, if the answer to this question is no dominant cycle, then I go to 5. If no cycle, then scalp using volume bar rotation cycles. And we'll look at that also. So here is an example of a range bar that's not that good. And this is important that you understand this idea. I'm going to spend just a moment talking about this, what my experience has been with myself going back years ago, and then with the traders that I've known, and now with the traders that I train. A very common phenomena with day traders is that they start at a pretty good level of a price bar. They may be using 30-minute price bars or 45 or 1 hour price bars for perspective, for getting the trend of the day or the trend of the past few days, and then they may be drilling down maybe to a 10 or 5-minute price bar for trade administration. And what they notice though is if that they use a shorter time frame, they can get in on their winning trades earlier and out of their losing trades earlier, and that's very appealing. The problem is that comes at a very steep price. As soon as you go below that 10-minute time frame, you really have to know what you're doing in terms of filtering trades, because as soon as you you go below about 10 minutes, you start introducing lots of market noise. So while it's true that on your winning trades, you probably will get in earlier, you're going to have so many more losing trades by whipsaws unless you really understand the process of filtering out bad trades. Like for example, in the stock indexes, we can use New York Stock Exchange internals. We can look at a larger time frame and find the trend of the day in that time frame and only take our short time frame trades in that direction. But I think you understand what I'm trying to say. Lower the time frame, more market noise. You can do that with range bar 2. Here's a range bar value of 0.001 for the EURFX. And what you can see, it's very choppy. There's lots of trend line breaks, swing line breaks that don't go anywhere. And a lot of these divergence arrows are some of them are good and some of them are not that good. When you look at the Stoch RSI, you can see how choppy it is. I don't get a smooth cycle up and a smooth cycle down. So if I use range bars intraday to reduce market noise, but if you use too low a value, you've defeated the purpose. So most of the time, what you'll see me doing is how do I determine it? So what range bar value to use? Once again, I'll take, for day trading, I'll take a 1-minute chart of the market I want to trade. Then I do the true range average indicator using 8. And then once again, I want to find those places where I have support and I have resistance. That's step 1. Once I get an area like that, this horizontal line, which is about 0.2, then the next step is to place the dynamic trio on it with the default values and the Stoch RSI, and I want to make sure that there are at least several points where I have clear support resistance offered by the swing line. Once I see that, then I know I have found a range bar value that'll be useful for day trading. I also want to look at my Stoch RSI line and see that I've got a few clear, not jagged cycles up and down. If you compare this to this this chart, the red line, that's just terrible. I mean, that's whipsaw heaven. You just double the range bar value and you get a much nicer flow. The other thing is what I do with the Stoch RSI on this range bar is I'm not really trading it. What I'm using it for is to determine the direction I want to take the trades in. My volume bar chart that we'll look at in a moment is my trade administration screen. I use that for entering and exiting my trades. This range bar chart, I hardly use it for trading other than to find out, am I in, where am I here? So since I'm using it for cycle identification, one thing I can tell you is that unlike what I would do in a volume bar or a short period time frame like 3-5 minutes with any other momentum oscillator, there's no such thing as overbought or oversold here, okay? You can get down here and you can stay here in a range bar. You can stay down here for over a day. You don't, wow, I'm totally oversold here, so I'm going to take on my volume bar chart the first buy signal because I bet it's going to race up. I'm oversold. It doesn't work like that. You're dealing with a different chart form here. You're dealing with a strongly noise-reduced chart form. And when it goes up here or down here, it can stay there for hours. Each one of these range bars may have been formed in 20 seconds, 20 minutes, or 2 hours. A range bar removes time from the x-axis. As such, it has a particular value to us, but it also, every time you get a plus, you get a minus. In this case, the minus doesn't hurt us. We're not using this for placing trades. We're using it as a filter. So I don't want to beat this to death, but what I'm trying to say is just avoid using, if you're going to use my methodology, just forget about overbought and oversold. Sometimes it looks really cute here, but my volume bar trade entry will get you in and out of these swings nicely. And then, if you forget about the oversold, the volume bar system will keep you inside that swing for most of its duration.
Yuri, do you wait for it to break that line, go in the opposite direction to change your trend, or just turn?
Oh, we're definitely going to cover that. There's a structured methodology to that. And we're going to get to that in a few slides. I also wanted to show you that, I always have one of these on my range bar chart. If the range bar chart is just ridiculously choppy, which we had actually in July and August, was really probably for the worst in over a year. This past July and most of August, it was very bad for EuroFX trading. Lots of chop. We had just finished a beautiful 6 months where almost every day we had swings up and down. And now that looks like the Labor Day holiday's over, this past week was pretty good. So I feel pretty good about it. But if we're in what I would call just the normal EuroFX, the way I've known it for years, I use this Fibonacci price expansion on one of the charts in the direction of the trade. And this is something that I'll be using for additional confirmation. But in and of itself, I don't really enter trades from my range bar chart intraday. You know, it's kind of like a filter. It's kind of like a confirmer for me. So, you know, same thing, range bar chart, but normally I'll do it. I just wanted to show you that. This is the way I normally do it. I'll have both, you know, the ABC and the ABB, so I can look at these bands, because these bands to me are just so important for maximizing profit. And also, if I want to, for some reason, you know, we don't see the Stochh RSI here, but if I wanted to like sell in here, the fact that I pivoted inside these bands has extra meaning to me. Under normal circumstances, if my Stochh RSI is still rising and everything, I really would just wait for the next buy signal. But if I see I'm pivoting in here, I have no problem scalping contra trend. So I just wanted to show you the components, and we're going to look at two different methods. The one I want to spend most time on is this one right here. For most people, this is appropriate. This is appropriate to those people who are very patient day traders, who totally don't like scalping. They feel that when they scalp, they exert a lot of energy to either make or lose a little bit of money. And they also have that perspective of wanting to wait patiently for clearer trade setups to develop. And in case you think that's you, every person I train tells me, when I run through the spiel with them, everybody I have trained tells me that's the type of trader I am. And then when I observe them, that's not the type of trader they are. So, but again, we're going to spend this is a very simple system, and it's pretty effective. But you may go up to 2 days without a trade, and then you may have 2 trades in 1 day. You're never going to have 5 trades in 1 day. You're never even going to have 3 trades in 1 day. Two would be pretty rare. And that'll be the first one we look at. It's pretty simple. I just wanted to show you that when you reference these are all the components you would use for each of the trading methods. So you have one screen that shows you these are the indicators you need to draw, and these are the parameters that you'll be using. There's one mistake, it's not a mistake. This is what we used for a long time. The 6E is a growing contract. More and more people are trading it, and just last week we shifted from 600 to 750. So when I created this chart, we were using 600, I think, from March up until the beginning of last week. And now 750 is just right.
Do you take the total volume and divide it by an X number to get to 750, so you trade so many bars in a day?
No.
How do you do it?
I try different numbers, and I eyeball charts.
Okay.
And I rely on my gut feel. There you go. So we're looking at how to create a range bar. I think Perry covered this yesterday, so I won't really spend any time on here. But you know, for the EuroFX, actually, you would check this. So I apologize. That's a mistake. There would have to be a tick here. For the swing trading part, where I'm using 0.005, you don't have to use tick data. You can use the default of 1 minute bars. But when you're going down to 0.002, you want to you have to use tick data. What this chart is about, there are probably a few people in here who trade the Euro USD through a Forex dealer. Is there anybody here who does that? They use a Forex dealer? Wow, okay, 3. That's not that much. So, but I trade the 6E primarily. I traded through a Forex dealer for a couple of years, and then early this year I switched to the 6E. And what you can do, see, the Forex dealer, their data stream, they don't supply volume, so you can't create volume bar charts. We're going to see, I create a volume bar for the, you would have a 750 here now. If you're using a Forex dealer, I use a tick chart. That's what I recommend, and that's what I used in the past. Of course, right now I'm using this, but for those people trading through a Forex dealer, you would substitute this tick chart with these values and treat it exactly as the volume bar chart that I'll be showing the examples for. So right now, we're not going to use volume bars. We're going to look at that first trading system, that method I described. And this is really all it's about. It's looking for a point in time where price retraces, the range bar chart of 0.002, the range bar chart retraces to the dynamic trio swing line. And I call that, in both methods, when price and the swing line come together, as soon as they get to within 2 ticks of the swing line, I call that a decision point. You don't really have any activity to perform. There's no reason to be staring at your screen when you use this method. It's probably one of the easiest things I've ever seen to day trade with. You can even create an alert in Fibonacci Trader to notify you when price and the swing line are coming together. And then you have a very quick process. The alert, or your visual identification of price and the swing line coming together, is number one. Number two is you immediately look at your Stoch RSI next period, and you take a look at where is it. Now, the fact that the Stoch RSI here is in what traditionally would be called oversold period, because this is a range bar chart, it has the exact opposite meaning. The further down you are, the stronger the downtrend is. It's not that it's oversold. So when you see your swing line and price coming together here, and you see that thick blue line all the way at the bottom, you start getting happy, because you know you're inside a very strong down cycle, and you know that this correction to the down cycle could very well be ending there. Far better than Fibonacci retracements. Now, I'm showing a little bit more complicated version of this, but this is probably how 3/4 of the trades will be. Because you may be in a correction that's going on for several bars, your Stoch RSI own may be rising. So if I get this situation, the way I handle it is I place a sell stop right below that pivot. Okay? If I had a situation where the red line, the own period of the Stoch RSI was falling, and my next period is bottomed out, I would try to sell as close as possible to that swing line, because I'm going with both trends. But what I normally will do, if the own is going contra trend, to be on the safe side, I make the assumption that if this holds and this is taken out, if both those conditions are met, the trend is resuming downwards, and I'm going to get extension by selling down there. And let's look at another example. Here would be the simpler version. This only occurs 1/4 of the time, but when it does occur, it's very sweet. And I do have traders out there, believe it or not, there's not too many of them, who will only trade this one and not the first one. Because in this one, when price came back to the swing line, this red circle here, notice that both Stoch RSIs are in an upcycle. If I can place my order right by the swing line, I have a big benefit. The big benefit is that my stop loss is ridiculously small. You know, you're dealing with the trade that may go hundreds of dollars into a profit quickly, and you're starting to trade out with the 5-tick stop loss. That's really hot. So this doesn't occur as often, but when it does occur, it's a really, really good trade, and everything you'd want about a trade is there. You're getting the end of the correction, you have a small stop loss, you're going with 2 different trends, and you're doing it all on a noise-reduced chart. So any questions on either of these two?
Where would you exit?
We're going to get to that at the very end of this presentation, because unlike overnight swing trading, day trading is kind of different because you have time limits and you have increased volatility. So right now, I'm primarily going to focus on this method and the next method on trade entry and where you would place your initial stop loss. As far as taking profits, I'm going to wait to the end.
What's the swing line?
The swing line is, you can see it right, it's the dynamic trio swing line.
Dynamic trio. Is it somewhere here where you've got the parameters set up?
Yeah, if we go back a few charts, it's right in here. Yeah, see, dynamic trio own. Yeah. So I think this is the chart we just finished, and what this is, I just want to show you about a full week of the EURFX with this method, and you can see how many times it occurred. Each one of these circles is a valid trade. Okay, where the price and swing line come together, and the Stoch RSI lines are following the rules that we just finished covering. So you can see that, it doesn't happen often. You have to be a very patient person. But you can also see that some of the profit, we're dealing with a 40 point, the y-axis. So to put this in perspective, that's 40 times $12.50. That's $500 a contract. So if you were to catch this puppy, you're dealing with $600–700. And here's the bad news. This is day trading and everything, but again, this is for more patient traders. It's not for everybody, because this trade from here to here may have lasted 6–7 hours. This is a range bar chart. It reduces time. It eliminates time from the chart. So this is a pretty potent trading method, and regardless of how good it looks, I guarantee you, when you put the trade on, most of us lift our profits really early. I mean, you may get in here, and watch yourself go into a $450 profit, and then you watch it turn into a $100 profit. How many people really have the fortitude to sit through that before they get their $700–800 profit? All right. So I'm just pointing this out because this stuff really looks good, and it is good. But just like Perry said, there's a battle being fought between the ears, and this is really, if you don't think you have it, a system like this will really show it to you. So I'm going to show you. Just this, on Friday, I did the week that just ended. And let me see where that is. That would be right here. So this is, September 1st through September 9th. And, just a quick review, each one of the red circles would be a situation like that, So it does occur. You get several trades a week, but you can also go a day, sometimes even 2 days without a trading signal, okay? So I just wanted to cover that one in brief. And we want to spend more time on, I'm sorry, wrong chart, wrong program. Yep. Oh, I see. I also did the first week of July. So this was the last week of June, first week of July. And again, I don't want to spend too much time on this because this is a pretty easy concept to get. But again, each one of these red lines, and you can go down the vertical line and see that in point of fact, the swing lines would have had you trading. And here's the good news. You don't see too many losing trades there, do you? Isn't that nice? If you look at last week, the last week of June, first week of July, and then the first week of September, there were a couple of losing trades. In the first week of September, there was one losing trade in the last week of June, and so this is pretty good. It's a hard system to trade, even though the trading rules are simple. But if you're willing to put up with the mental discipline, emotional discipline, this is actually pretty nice, even though it's a very simple trading system. Yes.
Just a little right of center, you have 3 in the same direction. Do you use those as add-ons?
No, you know why? Because again, you got to remember that this is, you don't see the time element. You don't know how many hours are passing. Now, again, you can certainly take, what the phrase is, take the ball and run with it. I'm showing you how I use it, okay? And if you can devise a setup where you can add to it, but generally speaking, no. For swing trading, overnight swing trading, I've got rules for adding to positions. But normally for day trading, I don't do that. I'm not saying it's a bad idea, not in the slightest. But for the way I trade, I find that, let's say I'm on $350 per contract in a profit. Here's my concern, that if I add on there, all I need is a 25% retracement to turn that $350 profit into maybe a $100 profit. Because I've reduced the win on the original position, and then I have nothing but a loss on the second position. And professionally, because this is my primary source of income, I'm a little bit more conservative with my day trading profits. But again, you can probably, if you've got a structured, all I can say is, if you can write it down on paper and review it and see that it works, do it. But for my type of trading style, I'm not willing, once I get a nice profit, to give too much of it back.
Well, some of these trades extend over a day, correct?
Correct.
But you're day trading it, so you're flat at night.
Not necessarily, because I may place an order in the market. Again, I don't do that often, but what I'll do, if everything's lining up and I'm happy, is I'll simply place, let's say now I'm at a $400 per contract profit. I may take a look at where the swing line is, subtract a couple of ticks, and place, a trailing stop right there. So when I get green, 8 hours late, let's say the last time I look at it is between 10 and 11 at night, then I'm back in front of my PC at 6:30 in the morning. I may have a pleasant surprise, right? If I get stopped out at the trailing stop, that's where I would have exited anyway. And, if I'm lucky, maybe I'll be a few more $100 in the profit. Yeah, the thing that's unique about the EuroFX right now, maybe the stock index futures trade, 23 hours, but that's really nonsense because most of the time they're brain dead. The EuroFX has slower periods, but it does trade. Almost any hour of the day you can see something going on, even if it's slow. So yeah, this market, it's blurring the distinction between day trading and swing trading. This is where I talk a little bit, because we're going to get into the next topic and stay there for at least an hour. So this is my chance to talk about a little bit about trading psychology, which I feel, again, is very important. This isn't the type of, this is more of a techniques seminar. And it's, when you do trader psychology, it's really not fair to devote 5 minutes to it, because if you treat a topic superficially, it's just as easy for the audience to get a misinterpretation, if you can't go a little bit in depth with examples. So, but these are higher level types of things that I think are worth sharing. And this is not the type of stuff you're going to get in one of the more popular trading psychology books. Or I know, SFO magazine, they usually run 3 trader psychology articles an issue now. I have a little bit of an argument. You know what? So I'm going to stand on my soapbox for 1 minute before I cover this. And I have a slight argument with the vast bulk of the trading psychology methods that are being presented to the public, because some of the underlying assumptions are not sound. The first assumption that they make is that it's possible for you to develop or purchase a mechanical trading system which will be consistently profitable. And the main job of the trading coach or the trading psychologist is to get you to follow it religiously and unemotionally and with great discipline. And that's a horrible assumption, because most of the stuff that's being sold to the public or that novice traders develop themselves is really not very good. Somebody is discovering the current random clustering effect in the market. They're building a system based on that. They can show you how in the past year, just how profitable it was, or in the past 2 years. And lo and behold, 2-3 weeks later, it doesn't work anymore, because the clustering pattern, the volatility pattern in the market changed. But your average trading psychologist, if you follow their instructions, they would have you unemotionally, in a detached manner, following the rules of that trading system religiously. So what they're training people on would only really work if you did have trading methods which were profitable on a consistent basis. I'm not talking 100% wins, but I'm talking if you're day trading, at the end of every week, you're profitable. You know, as a day trader, it's okay to have a losing day, but it's a little weird if you have a couple of losing weeks in a row. Okay? And if you do have that and you follow your trading methodology without question, then I'm not sure that's a good thing. You can disagree with me, but in my personal trading, that would be unacceptable. Another problem I have with what's being taught to traders is that whenever I've done anything in any area of life where I got positive reinforcement, I've wanted to do it. And it wasn't a big setback. So let's say, most of us here appear to be middle-aged or older, except for a few, but think back to when you used to play sports. It really wasn't a big deal if you were playing the sport you liked that sometimes you lost. Or if you were playing golf that sometimes your score was low. It just didn't matter because you liked the sport, and the frustration of not always being stellar didn't really bother you. But if you do something that you don't like and you force yourself to do it, the frustration factor just builds and builds, regardless of what any trading coach tells you or regardless of how much discipline you're able to affect in your trading style. So that leads into this first point, because my personal belief is that if most traders structured their trading the right way, which was instead of taking the popular indicators out there, applying them to a regular price chart, and doing some sort of system development that involves optimization, that is not based on any sound market theory whatsoever. As a matter of fact, it's antithetical to sound system development. And that's what most traders do, and that's why they need trading coaches telling them, hey, you just follow that religiously and maybe something good will happen someday. If you start from the ground level up and develop your own trading philosophy, your own market theory, and start structuring trading methods based on your understanding of the markets, then my guess would be that you will probably develop a much more quicker something which is profitable, and two, trading it won't be a bear. It won't require someone beating you over the head and telling you that you're not disciplined, you're too emotional, because human nature will take over. And if you're following a system which at the end of every week is profitable, you will naturally and automatically get positive reinforcement from that. Right? It's natural. If I'm doing something, one, that I like, and two, it's working, I don't have to really worry about the discipline, because you're going to look forward to the trading day starting. You're going to look forward to placing your trades because you're getting positive reinforcement from it. So that finishes up point 1, and also finishes up point 2. So that's pretty much what I was trying to say in these 3 points. And what I tell people over and over, and I even have to tell myself over and over, is that unless you're a scalper who's got a pretty good scalping system and you're used to placing over 50 trades a day, if you want to sometimes catch larger intraday swings and put up with the minor zigzags inside those swings as you're using a trailing stop, this is the only way to go. In our work ethic, the way we've been unconsciously taught, a fireman has to be trained. They only go out when there's a fire or some other sort of emergency, and they're not really being lazy or inefficient or useless when they're not taking their fire engines through the street if there's no emergency. In a similar manner, a hunter knows that when he's in the bush, he may stalk a deer or whatever he's hunting for 3 days. It's not uncommon to hear stories of hunters going after more exotic game and stalking it for a full week, where they're primarily just lying in camouflage ready. They're in a state of heightened alertness, but they're not doing anything. That's actually part of the game. So a lot of times in trading, what this is analogous to is watching your particular setups, noticing that, okay, now I have, if you're following my methodology, it would start with price being by a swing line. Now I have to execute a few other steps to see if this is a trade that I'll take. And I call that confirmation and filtering. But probably 3/4 of the time, I go from potential trade setup to watching it get filtered out because it's not clean enough. And that's what this is about. So this is actually something I have to remind myself almost on a daily basis. The correct analogy, the correct frame of mind. Okay? So this is fortunately the end of my trading psychology talk, but now on to the trading part. So we looked at range bars, and yesterday Perry introduced what a volume bar is, and a volume bar, each bar shows the price range traded for a specific number of contracts. It's similar to a tick chart, but it's not identical to a tick chart. The difference is that in any given tick, you don't know how many contracts transacted. To me, there's a big difference between one contract, retail traders, most professionals and commercials and institutions and hedgers don't trade one contract at a time. And I want to know when larger money is entering the market. So I like tick charts. I use them sometimes when I'm scalping. But in my normal day-to-day trading, I like the volume bar chart because it gives me just a little bit more information. Again, just like a tick chart or a range bar, it removes time from the chart. It's more sensitive to momentum changes, and it's excellent for administrating trades. And we're going to look at that in detail. So why am I saying that? The next few charts will show why I'm saying that. But one characteristic that we find with these volume bar charts is, unlike a regular price chart, if I have a wide range like that, I have reason to expect that that's a powerful move. In the volume bar chart, it's exactly reversed. When you have a wide bar like this, you have reason to suspect that that's a rather large price range covered by the same number of contracts that did that. So there's reason to believe that the upswing will pause for a while. When I start seeing these big wide guys like that, like for example, this let me know that this is just a profit taking to this downswing and that it probably will resume. Why is that? Because the same number of contracts that produced these drops is now producing a big wide range like that. That's not a lot of volume. This retracement was done on very light volume, so I'm looking, when this swing line gets broken here, I'm expecting this swing to resume again. You'll find, this is not something that we use in our trade. This is just something I'm sharing. I don't make the length of a volume bar a part of my setup, but it's just an observation I've made. And just a little bit more information that this chart form gives you. And this will be, again, a very similar way to how I create the value for the range bar. Most of the time, it's just an eyeballing technique. But normally what I'll do is I'll plot, again, just like for the range bar, so 1 minute chart. And then I'll chart the actual volume for that contract. And what I'm looking for here is kind of like an average. It's kind of like when you do Olympic scoring. You drop the lowest and you drop the highest score. So here, I don't care about the bottom, obviously. And these spikes up here are so infrequent that I drop them. So I just look for an area where there's resistance here. Median, middle level. And then I create that chart and I eyeball it. And I may have to modify it a few times. And then, I apply for volume bars, I apply the triple switch swing line. And I just want to make sure that when I see that swing line and those volume bars, that it contains trend very nicely. And if I see that, then I know I've got the right volume bar. And range bars, when you find the right value, they'll last for years. Volume bars, you have to review every few months. Okay, if you go back 2 years, we were using a smaller Russell volume bar than we are now, because the Russell's really grown in popularity in this year here, in 2005. The 6E is every 3 months, it seems to be growing in volume, daily intraday volume. So these are the rules for the trade. This is a trade that I use the most. And I use this on all the markets that I trade, day trade. I'm usually day trading 2 markets simultaneously. And this one trade here, we'll cover them all. And we're going to look at examples. But let's quickly, don't try to memorize this now, because all of the slides, we're going to see a lot of slides after this where we apply these rules. But just that, it's the same idea, these rules, that the first thing you're looking for is price and a swing line getting together. But in this particular setup, you're waiting for price to penetrate a swing line by at least 3 ticks. In the prior trade setup, we just wanted to see price coming to within a couple of ticks of the swing line. Here we want to see an actual penetration of the swing line by several ticks. Then, like 3 ticks, then we take interest. And what we do is we go to our RB, our range bar chart, to see if we've got any cycle stuff going. But anyway, you can refer to these rules later rather than just read them, which is not kind of difficult. Let's start looking at examples. Range bar chart on the left, volume bar chart on the right. So this red circle, I'm sorry, not that red circle, the one. The one here shows me where price penetrated the swing line. So that's number 1, price penetrating a swing line. 2, you go to your RB chart and you look at where is my cycle, where is my Stoch RSI. We see that it's already falling. So in that situation, you can either place a trade, or if you want, you can check, and I'll tell you why we do this. The vanilla version is really pretty much a 2-stepper. Okay? Swing line break, going in the direction of the main trade, place a trade. The slightly more advanced version would have you looking over here. Well, if I see that this is falling, I'm just getting in. I'm not waiting for anything else. Whatever the price is shown here, I'm pretty much going to get in at the market, because I can't create a better situation than all 3 events being true simultaneously. Swing line break, cycle down on 2 different chart forms. So what's this red line about? Let's say, for example, right here, that we shift this forward. Let's pretend that the Stoch RSI is rising. If I see I'm going contra trend on my volume bar chart, I don't enter. What I do is I wait for the first pullback to the swing line. That's what that red line represents. So, and anybody who's traded, several people here have traded with me, a few people got the day trader course, they know that to me pullbacks are really important, because most of the time you're going to see that on the swing line break, when it's in your direction, this guy is going contra. This is a very quick correction. What if the correction were 5 bars? Well, you'd have your Stoch RSI going up. So most of the time, probably 3/4 of the time or 80% of the time, I'm actually entering the trade, not on the break of the swing line, but on the first pullback to the swing line. And you get an extra added benefit when you do that, because most of the time your entry is going to be within a few ticks of where you would have entered anyway. Sometimes you even get a better entry, but here's the real important point. The important point is that when you enter right by that swing line, you have a very small stop loss. When I enter over here, I'm doing it because if I got all the cycles agreeing, I may get very quick follow through. I don't have a lot of time to stop and think. But if I've got the Stoch RSI rising here, if I've got like a mini correction here, a mini trend within the larger downtrend, then I do have time to stop and think and use a better entry method, which would be a pullback to that swing line. So let's look at another example. Yeah?
I'm just curious about, I think somebody earlier had asked about re-entering the trade, but in theory here, you would have been short from that first.
Yeah, in that trade. Yeah, let's go back to it. It's actually not, this is actually trades that I did. I was actually trading while I was creating these slides. So this actually is a trade I did. Yeah, I did short in here. And did I wait to get back here? Believe it or not, no. Believe it or not, no. I placed a second trade here. Why didn't I wait for price to get back in there? Because I had already a series of Fibonacci price bands that I didn't have to wait for, all of that. I kind of got out right when this high was taken out. I had Fibonacci band. That's outside of scope right now. That's too complicated to go over now. If you follow the trading system exactly as given, it'll be fine. And then as you get fluent, as this, what I call, once you get a sense of ownership of the tools, then you can start applying other filters and market geometry and other things. But first you want to get, because this trading system as given will be, at the end of every week, I'm pretty sure you're going to be profitable.
Would the entry on the pullback be right at the swing line?
2 ticks. Yeah, because You can't do it right on the swing line. Here's why. Prices trade in a bid-ask spread. So many times price will touch that swing line and pivot right there, and you've got egg on your face because of the bid-ask spread you didn't get filled. See? It would have to penetrate that swing line by 1 tick for you to get filled on the bid-ask spread. So to be on the safe side, I don't even do 1 tick, I usually do 2 ticks.
Below the swing line.
Yeah, in this case, below the swing line. And if price were rising, it would be, like 2 ticks above, yeah, like that. So this is, we're going to go through a bunch of examples, then we'll look at a couple of tick chart examples for people who are doing your USD through a Forex dealer. So it's the same scenario. Over here, break of a swing line. You go to number 1. That's that break. Then number 2 is you go right there. Swing line is falling. I'm sorry. Stoch RSI, the cycle is falling. We're going down. And then the third thing we do is we go to our Stoch RSI. And what I do is I want to see, when I go over here, I want to see that I am at least on the 3rd bar, which is falling. Okay? It doesn't have to be 3 complete bars. The current bar could be. But, some of this stuff sometimes looks so good in hindsight because you see the follow through and you see that range bar finished painting. But in reality, what I'm doing is I want to see that I'm on the 3rd bar. It doesn't have to be finished painting in, but I want to be on the 3rd bar that's either falling or rising depending on the direction of the volume bar swing line break.
Third price, your third range bar.
Yeah, 3rd range bar. So that, you enable in Fibonacci Trader the crosshairs that display in all the windows, right? If you were backtesting this. If you weren't backtesting in real time, you wouldn't need crosshairs because they would be pressed over here. But yeah, it's the range bar. So if you look at this, I'm probably in my 4th range bar going down over here. That's why when you hear me say 3/4 of my trades get filtered out, it's because of that. I may look and I'm only in the 2nd range bar going down, and I know from experience that, by the time that range bar finishes painting, price may have reversed, and that Stoch RSI may be pointing up instead of down. But if I'm in my 3rd one going down, then I know at least I've got 2 behind me that are confirming that there's a change in direction, or I'm already inside an established downtrend. This is actually the